Hello and good afternoon, everyone. My name is Rachel Deshelle, Senior Manager of Trading Services here, and your host for Trading Price Patterns, where we do exactly that. We look through the market, look at individual stock patterns, and trade those from what we're seeing. Now, we are joined in the chat today by Mike Fairborn. Please chat in your questions, comments during today's session. We'd love to hear from you through there. And please follow us on X, Mike Fairborn CS, Rachel-CS, and please give this video a like, a thumbs up, and please subscribe to us on Trader Talk Schwab Coaching to our YouTube channel. So today we're going to cover trading some range-bound patterns and then looking at other formations stacking up in the market. But before we get to our full agenda, we need to cover a few disclosures here. So first, options carry a high level of risk and are not suitable for all investors. Information we're going to cover is for informational, educational purposes only, is not a recommendation or advice. And we're going to place some paper trades using the Paper Money platform. It is a bit different from live, so keep that in mind. Now, as far as our agenda, we're going to skip the announcement for today, but we'll start with that market overview that we usually do. We'll review old trades, make some tweaks for future trades. We will look at price patterns, place new example trades, and walk through the trade management for those. So let's move into a market overview here. We are seeing big things develop here in the Dow. We saw a gap up today after it made a new high on a closing basis yesterday, obviously making new all-time highs today with just marching higher above that 20-period simple moving average. Let's just see how far it is extended from that now. It's about, I want to say this is close to 3%. Yeah, close to 3% above its 20-day. And I think the interesting thing with the Dow, compared to some of the other indexes, the Dow is weighted more heavily towards financials. That's the biggest type of sector exposure in the Dow. So I kind of find that interesting. I know traders will probably find that interesting that the Dow is kind of one of those that is making new highs. Obviously, tech right behind it, and healthcare as another huge sector in that index as well. So the trend is your friend. It continues higher there. If we take a look at the NASDAQ, obviously a different type of setup forming here. We had that hammer candle, that bullish reversal candle at the 50-day simple moving average, gapped higher above that, above the 20-day simple moving average, formed that inside bar or that Harami candle yesterday and Monday as that kind of took place, signaling a little bit of a pause, which makes kind of sense because we had a large gap up, a large move. So it makes sense to have a little bit of a pause there. But then today, if I zoom in a little bit closer, we're almost seeing, I mean, we can't tell until the end of the day, obviously, where the close takes place. But for right now, it's looking like that this is forming a bearish engulfing candle. And the reason why it is an engulfing candle is because if you look at the body of the candle, so the opens to the closes, it's completely encapsulated or engulfing that previous body of the candle with the open and the close there. So we'll kind of have to see where it plays out by the end of the day. Obviously, it's not a confirmed candlestick pattern until we get to the following day and actually see some follow through. So if this does end up being a bearish engulfing candle, I think traders will look for an invalidation above that high of today's candle to invalidate that as a bearish engulfing candle. Obviously, if it stays within the range or moves lower, that's that confirmed signal for that being a bearish engulfing candle. Now, let's move to the S&P 500. I'm going to zoom out here. We've obviously noted this rising bullish channel where we broke through on Friday, another hammer bullish reversal candlestick taking place right at the support of the 50-day moving average. Similar price action to what we saw on the NASDAQ with a gap higher above its 20-day. And we are chugging higher and higher today. It's honestly looking like we're going to form a little bit of a hanging man type of candle setup there, because this is the short-term trend. The last couple days has moved up, and we have the the open and the close of that body of the candle being a little bit tighter, really close to the high of the day, showing that kind of battle taking place there. So that could be a possible bearish reversal candle. We'll obviously have to see after the close today. So now that we've kind of reviewed the major indices here, I'm going to look at a trade that we actually just closed out today, actually. So I'm going to go to Wells Fargo because this is a pattern that we actually spotted on the 20-day chart. And we had a breakthrough of that ascending triangle formation. We bought a long call, and I'll look at that exact trade details in a second. But obviously we had a couple false breakouts and a break-in structure for that pattern. And then we saw a move above it today and then got stopped out. So to kind of tell this story of what we are looking at, I saw the move today, moved up this stop for this. We still ended up down, I think 200 or 300 on the position. And I think the main kind of issue with that was that we could have put our exit when the price pattern failed, because a lot of the times what we see with patterns, obviously we know that they're not guarantees, and sometimes they may have false breakouts, sometimes they may break out in the initial direction like this one did, and then they may fail and move back from there. So what we could have done and what we will do in the future kind of going forward as we manage these trades and we trade these patterns, we are going to make sure we place an exit order if the price of the stock falls back into the formation of the pattern after the breakout. So that's kind of something we're going to do for next time, I guess I should say. And so we got stopped out at 460. So that's kind of the resolution for that trade. So we're not in any other trades right now. So we're going to look for some different trade examples, and a couple that I've been watching here. One is Adobe, and Adobe's been one of those that has just been in this downtrend pretty much all year, making lower lows like right here, and then starting to make the same level of lows, really bottoming out and creating this rectangular basing pattern that we see here. So I'm going to zoom in a lot closer to this so we can kind of see. It has banged its head on this lower support line 1, 2, 3, 4 times, even with a failed move beyond that. Like we said, patterns do fail sometimes. So if they don't breach a certain percentage filter, move out of that pattern, and they move back into the pattern, that's where you could see that fast move possibly in the opposite direction there. And we know our resistance is up ahead right around that 365 zone or so, where we've obviously seen price take a few hits to that level as well. And so in this case, we do have earnings about a month out from today, and implied volatility has been relatively high in Adobe. We obviously saw a decent bounce here with 4 green candles and a move. We actually see the moving averages looking like they're starting to flatten out a little bit. So this evidence could kind of give us an indication that because it has traded within this range for about 4 months of time here almost, we could see price move its way back towards the upper part of that range, giving us a little bit of an indication of a bullish type of trade there. And of course, traders may trade the range of this as well, creating almost like an iron condor with this setup here. So they could sell a put spread to the downside down below here and a call spread to the upside, and they could do that. Now today though, since we're kind of looking for more of a bullish directional move over the next month, over the next 30 days, because we would want to close out a position prior to an earnings announcement, we may look to buy a call on this with a target up towards the upper bounds of this range. Or since implied volatility is relatively high, we may look to sell a put spread here. So let's just take a look at a couple components on the trade tab, and let's take a look at implied volatility actually. Well, I'm going to throw that on the chart. So I'm going to show implied volatility there, and we can see that it is creeping up. It is at one of the high levels that we've seen, almost like its own type of resistance throughout the year that we've kind of seen here in implied volatility. So that would tell a lot of traders that, hey, now's not a great time for possibly buying options because you may be overpaying since the volatility is a little bit high. But what you could do is sell options, or like we mentioned, sell a spread to take part in the directional move of this, possibly to the upside. So that's what we're going to look towards today. And I see a couple questions in the chat. How do you know that volatility is high? I just checked it before, and then as I was prepping for this webcast, and then wanted to show you it on the chart here, and I'll show you it on the trade tab as well. And then Chris, you asked, not concerned with the diagonal resistance down trend line. Let's draw that here. So if we want to draw it from here, we could take it right about here, which puts us at the same level, that descending trend line, right around that resistance, that horizontal resistance at the same time too. Of course, you could draw it a couple different ways as well, but I think traders place a lot more importance, especially on those horizontal support and resistance levels, because that's clearly just looking at just the straightforward price there, any levels of lows and highs that we've seen, more than they would the trend lines. But in this case, we're actually seeing those really coincide around that same level. So that could be something that traders are watching. Good call out there on that descending diagonal downtrend line, Chris. Okay, so let's take a look at the trade tab. I know we talked about volatility being a little bit higher in this sense, and we looked at the past year of implied volatility where we saw the chart. But if we look down below in the today's option statistics, we can see that the implied volatility percentile is at 67. So it's in the upper two-thirds of, or the upper third, I should say, of where implied volatility has been over the last year. So that obviously gives us that other indication to look at an environment where we could possibly sell options in this case. So I do want to go back to this formation here and just look at the times and the amount of days that it took for it to bounce from support or resistance here, because I think this is going to be important as we look to craft our option strategy as well. And if we adopt a selling strategy, we obviously want to take advantage of that increased implied volatility. We want to take advantage of the time decay that we're going to see on that option, because we know that time decay works in the favor of sellers. So we're going to look for a shorter dated option. But just to kind of give you an idea, if we look at from highs to lows here, that took place in 10 trading days for that first one. If we go to the next one, that took place in 6 trading days there from lows to highs. We'll do that again with these highs to lows. That's 8 days. We can take these lows to highs. That is 4 trading days. Then we saw another high to low, which is a little bit longer. Looks like 14 bars, so 14 trading days. So that's about like 3 weeks. And then we saw another high reached in 8 bars or 8 days. And then we saw another low reached in 8 days there. So collectively, we're seeing these quick little bounces from support to resistance, which could tell us that from this move, which we've moved, let's see the percentage already. From these lows underneath support, we have actually had over a 4.5% move here. So a decent move already just in 4 trading sessions. So that could give us, we'll give ourselves a few weeks for it to reach that level. So when we're looking at the expiration date, I'm going to go over to trade all products here. And let's look at this option with Let's maybe look at the 19th of December, or let's look at the 12th of December actually, because it's a weekly option. It has 30 days left till expiration, and that puts us, that 12th of December is 2 days after earnings. So we'll make sure we just close that options trade prior to that earnings announcement. So I'm going to look here on the option chain. I'm collapsing the left sidebar here, and I'm going to look at what a desirable trade may be for this time frame. Now we saw support down around, what was it, 328 was that initial support that was broken. We made lows at 323. So we're going to look at that as kind of a level where we could possibly sell an option under, just to say that the price of the stock will stay above this level. We want our option to expire out of the money, in this case with a bull put spread. So I'm just going to look at a couple different things here. Let's take a look at open interest and volume on these options here. We do have somewhat of a wide spread on the put side. Let's take a look. Let's look out at the monthlies. I know it's a little bit longer, but the monthlies tend to have higher open interest and higher volume here. So let's take a look at the monthlies. It's going to cost us a little bit more time, but that's okay here because we're still kind of on that steepening curve of theta. Obviously, you can see theta decay is quite substantial here, still looking around, I mean, with the at the money options, theta decay being about 26 cents a day. The further we go out, we're obviously going to see smaller theta decay or time decay there. And so when we're kind of looking to craft this, we don't want a monster wide spread, right? We still want to stay within our risk parameters because we can place a trade that's a little over, our trade size is a little over $6,000 for this account, and we don't want to risk roughly like $1,100 to $1,200 within a particular trade. So we still want to keep that in mind as we're selecting our strikes. But if I look here, I can even look at the deltas of these options and use this as kind of an indicator as far as selecting a strike price. And because I want this to be a bull put spread, I want this credit spread to expire out of the money, I'm going to look for a smaller delta in this case, which will tell me that it'll give me a greater chance of that option expiring out of the money. And like we said, we're looking for strike prices that are below those previous lows, because if those lows are broken again or that support is broken again, we obviously want to keep that in mind and exit our trade there. So in this case, I'm going to select the 300. So I'm going to click on buying the 300 strike call, selling the 310 there for a $247 credit there. We notice that both of these, especially that 300, has a ton of volume today, a lot in open interest, a lot of open interest in the 310 as well. So we know that the spreads are going to be kind of tighter from there too. And you may, if you're new to spread trading, this is kind of something we can do, or you can do when you're kind of setting up this trade to really analyze your risk and reward. Because what we're looking at when we sell a spread, the most that we can make for this entire trade is what we're collecting on the credit. So that's going to be $2.47. And on a credit spread, it's not going to be a favorable risk to reward setup because you're always going to be risking more on the downside. And the downside is the difference between the strikes, which is $10 minus the credit that you're bringing in there. So it's about $7.50 to the downside. And we'll see this visually in just a second. But that's kind of the nature of these credit spreads. And it's because you're collecting that premium up front. You're taking this kind of higher probability type setup with this trade where it's going to create a little bit more downside in this case. So if I just right click on this option and click analyze trade, that is going to place us on the analyze risk profile graph. So if you haven't used this graph before, I'll just kind of explain a couple things here. So here, let's make this a little bit easier for you guys to see. Okay. So what we're seeing here is two lines. The purple line is going to indicate our position today. That's going to indicate the risk and reward. In this case, we have the risk to our downside on the y-axis, and then we have the price of the stock on the x-axis. So as the price of the stock goes up, obviously the curved line goes up, showing us kind of in that profit area. If we look to the downside, we can see that we're kind of put in that loss zone there. And then that blue line that we see here, this is our line of our profit and loss, our risk profile on expiration. So this is going to give us more of a clear-cut view of what it's going to look like when all implied volatility is baked out of that option by the time of expiration. So I'm just going to click on this 3-line menu to the right-hand side, set slices to my break even on the date after expiration. You always want to make sure that this date in the upper right-hand corner is the day after expiration. And same with just kind of double checking your dates down there. But we can just see if we put that slice on our break-even point on expiration, this shows us that our probability of profit in this case by expiration is roughly 70% or so. And another thing is we can see here our probability of max profit in this case by expiration. If we just move that price slice to where the graph kind of plateaus out, we can see that probability of max profit at 67%. So a trader may look at those as kind of more favorable odds there. Now, for our downside, obviously we can see, we talked a little bit about the downside being the difference between the strikes minus the credit. And you could see that visually here with it being a little more than $750 there to the downside. So do keep that in mind. That is what our risk graph will look like as we're kind of forming this trade. And I do see in the chat there, it looks like Mike put a survey in the chat. So I would definitely encourage you guys to fill that out. I definitely respond to all of your feedback, good, the bad, the everything. So we definitely love hearing your feedback here. We always take it into consideration. So please take a moment and fill out that survey if you can. But if we go back to the trade tab here, since we've analyzed our probabilities, analyzed our risk a little bit, let's go back to the trade tab and talk about kind of where we could take our exits here. So what we can do, we already know, we talked about closing out the trade prior to earnings on December 10th. So we know we're going to close it prior to that. But if we look and make this a first trigger sequence, we're going to change this order down here, make sure it's on a first trigger sequence. We can right click on this order and create opposite order for our closing order there. And we're going to lock that together. So what we want to do, since this is the most we can make, this is our 100% profit. In this case, let's stop ourselves out at a level where we are still having a favorable risk to reward setup for what we are allowed. Okay, I think I was lost for a few seconds there. Hopefully you guys saw how I set up this order. I just changed this to first trigger sequence. I right clicked on this order here. I created an opposite order. And then to look as far as where to put our exit to the downside, if we are, I guess to the upside in this case, but to stop out our losses, to manage our risk, we may look for a more favorable risk to reward setup, taking this as like our 100% profit. And maybe we only want to take a 50% loss in this. So what I could do is take a stop order in this case and actually take the price that we're bringing in, or the price that we are assuming that we're going to get a fill at, and multiplying that by 1.5. So I'm going to take 2.47 times 1.5. And that's going to put me at an exit at 370. So if we lose 50% on this option, because the most we can make is $247, if we lose that little bit, we are going to close out of our trade there. Now, the thing to keep in mind with stop orders is obviously this is just a trigger for a market order. We know that both of these options are pretty liquid. What you could always do is make a stop limit order as well if you want to have more control over the price, because we know as soon as this price of the option hits, we are sending a market order there. So we're going to make this good till canceled here. And we're going to keep an eye on this. Obviously, if price continues to decay over the next few weeks or so, if the stock does nothing or continues its move up, we're obviously going to see that passage of time benefit us over the next few weeks, because we know that we're going to see 21 cents a day in that case for our short leg there, which is actually a higher theta than our long leg. So that's kind of still why it's like that Vega negative type strategy there. So that's just something to kind of keep in mind. So it looks like our chat is back up. So if you do have any questions, please feel free to chat them in. Sorry for the interruptions there, you guys. But let's look at the confirm and send order. Just make sure everything looks okay. We are selling that vertical at a 247 limit, putting our stop at a 50% loss. We can see our upside and our downside that we saw on the graph. And let's just put this in the price patterns chat there. Okay, there we go. So we have that order in there and working. So let's take a look. Okay, there we go. Perfect. So that trade just got filled there in that case with Adobe. Now let's take a look. We have a little bit of time still, so we'll place another trade here. I'm going to open up my watch list yet again. One formation that we actually noted the other week here was this triple top formation in Hims and Hers. And we saw the last few trading sessions, we did have a breakdown from that neckline support with now 2 closes below that neckline. So I'm going to zoom in a little bit further here. And for those of you that haven't traded this pattern before or are new to patterns, this is a triple top formation, which signals a possible bearish reversal. And so a lot of times traders will measure the depth of this pattern, so taking the highs to lows in this formation and really projecting that downward to see where price could possibly go with that range of the pattern. So that's putting it on a kind of larger downside there. But let's just see, I'm curious to see how, what percentage move we've had beyond that old support, now new resistance. So I'm going to take a look here, look at where the price is trading now. We've had about a 5% move that we've seen there. So that's a significant, I would say, confirmed percentage move. I think in this class last week, we talked about looking for a 2% move rather than a 1% move outside of a pattern. And I know some of the older technicians that wrote the books would say a 3% confirmed move, or I guess a 3% move out of that support or resistance or out of that pattern would give us a quote unquote confirmed move. But we've seen a 5% move in this case, about to be 2 closes below. So that gives me enough of an indication that this could be a confirmed move out of that pattern there. Now, obviously with that drawing of that downside, possible downside, I should say, that puts us at new yearly lows. But I see, as a chartist, and many of you will probably see as well, we do have a significant couple areas of support where the stock may kind of find on its fall down if it continues to run to the downside. And the first of them being this earnings gap from looks like, well, it was a couple days after earnings, but the earnings gap right around 31 or so, that would probably be that first level of support that a trader may watch. So that's still giving it a $7 move to the downside. Now, the other clear-cut support line that I'm noticing here is this other level around $23, $24 to the downside, which gives it or I guess $24, I should say, which gives it a $15 move to the downside. So a couple different levels we could watch. We don't need to, I guess, swing for the fences on this trade. Like if we wanted to take a bearish stance in this case using, for example, put options, since volatility seems to be hitting a yearly low in this case. So we could take that directional put trade to control that 100 shares to the downside in a capital efficient way. But we may be looking for maybe some areas where price could find some stability, could find some further support, or we may want to take profit at. So we can be a little bit more conservative in this case if we want to, because obviously if we measure that move, it's been forming over the last 5 to 6 months with that triple top, and we see just kind of hovering over that measured move. That is a $25 move that it could play out in that longer period of time. So what we're going to do is we're still going to look further out in time to give this some room to possibly run to the downside, since the first level of support that we're seeing here is around 31, where we could take a little bit of profits off there. But we may be looking a little bit further to the downside around 24, and we want to give ourselves enough time in that case for it to possibly reach that level if it does. So let's just take a look at what we could do with this. I guess one last thing to mention here, we talked about exiting a trade when we're wrong and when price enters back into the pattern. So if price moves beyond this neckline support right around 41 or so if it moves up another couple dollars above 41, let's just say we want to get out of this trade, because then it just turns this trade into yet another range. Right now it's looking like it's a triple top because it's had that confirmed move down, but you never know sometimes if these could turn into failed moves. So let's just make sure if we are wrong, we are out of that trade with very little damage. So what we're going to do is look at a long put trade. And I'm going to go to the trade all products tab. And since we saw that took about 5-6 months to form, I'm going to look further out in time in this case. And I'm going to look all the way out to May of next year to give it a few months to possibly take place and to reach those levels. So let's take a look here at some of the options that we're seeing here on the put side. So we do have a good amount of open interest in these contracts, light on the volume there, but we do have a decently tight spread on these options as well, which would give us a couple different ideas that we could kind of use here. So let's take a look. Let's look at, for instance, this 40 strike put. This one has the most in open interest. It does have a smaller delta, but the 40 strike put is slightly in the money in this case. So if we just kind of use this one as an example, we could right click on that, go to buy custom with OCO bracket. And in this case, we're looking at not only taking our entry right now, but also placing a profit taking order and a stop loss in this case with this put option. Now, since we're just doing a long option, the most we can lose is that premium that we're going to pay. The most we can make is if that stock goes down to 0, which it's probably not likely that it would within this time or at all, but that's just kind of what the risk profile looks like for this specific trade. We're obviously going to stop out our losses a lot sooner than taking a max loss on this trade, because we talked about exiting our order to the downside if price moves above 41. So that's actually what I'm going to do on this order here. And I'm going to change this to a market order in this sense and just go to the little gear to the right-hand side and place this as a conditional order on the stock. So when it is greater than or equal to 41, we want to get out. Actually, I wanted to use a limit order. We want to get out using a limit order to have more control of our price. So what I'm going to do, keep this price as a limit unlink it here. And we're going to have the limit linked to the bid price in this case. So, because we essentially don't know what the price of the option is going to be, and we can do like a theoretical price calculation if it were to go above 41. But essentially what we're going to do is take whatever the current bid price is of the option at the time that the price of the stock is above $41. So if it sees a $2 move to the upside, we want to get out of this order using a limit order, and we're going to place this order with a limit price 1 cent below the bid to ensure an immediate fill, but still obviously have control over the price in this case. So I'm going to hit save. I'm going to hit save in that. Now, another thing we're going to do is look to the upside. So to the upside, let's just say we are looking for a, let's just say a 25% profit here, or even a 50% profit in this case. So if we were looking for just a 20% profit, we can take, or 25% profit, we could take 975 times 1.25 and place that exit order right at 12.18. Now, let's kind of go through that a little bit and just simulate what type of move we would have to see over that amount of time to actually see the price of the option at 12.18. So let's go to the column customizer here, and let's change that to Theoprice Mark. And let's just say the stock goes down. I have this by February, actually. By February, we're giving this a few months of time. And let's say if it goes all the way down to that lowest support level that we looked at. It's not moving the full length of the triple top that we saw, but it is moving a significant distance to that lower level of support, and multiple months have passed. Well, that's going to place the theoretical price of the option at 15.22. So if we take 15.22 divided by 975, that would give us just over a 50% profit in that case. Now, if we just saw what was the move from now to this one with the gap, if it goes to about $31 with that gap, let's just say $31, the price falls $8 within that time frame, we're now seeing that the theoretical price is $10.90. So it's not going to move that much in that case. So what we could do in this case, because that delta is going to be smaller, and we can see that next option, the 45, which is a little bit further in the money, that option is going to move significantly more if we do see that type of move to the downside. That will put us at 15.05. So something we could do is to kind of capitalize on a possible move. And again, we're looking far out in time. It's made a 5% move already just in a few days. But in this case, with the passage of time, this further in the money option is going to give us a larger delta. So what we could do is change this to the 40 strike put in that case. And so, or the 45 strike put in that case. So let's just see what it looks like with a 45. We're going to change these all to the 45. There we go. And then we're going to look at the current price of the option and place it at the midpoint here. So what we're going to look at, let's just say we're going to take this option and do a 25% profit for this one here. So let's take 12.90 times 1.25, and that gives us 16.12. So if it does make that $8 move in a shorter amount of time, we're obviously going to see our theoretical price be higher than that, just because of that time decay component over time. But in this case, if we kind of saw that move, we're going to take profit when we are at a 25% profit in that case. And we're also going to bump this up for 2 contracts here. Actually, we could do up to 3 in this case. We'll say we're going to do 3 contracts in this case. And if I hit confirm and send, oops, we need to lock that, make that all good till canceled. If I hit confirm and send in this case, this will give me an idea of how much we could possibly gain, how much we could possibly lose. So obviously we know that we're gonna exit to the downside at a limit order, whatever the bid price is, when the stock, and if the stock moves back into that pattern above 41, so we're gonna exit then. And then we're also going to take a 25% profit if the price of the stock does keep moving to the downside in this case. And we're using 3 contracts there. So I'm going to place this order and hit send there. And so we have that order in and working. So we've placed 2 trades there in that case. And we're going to go through, since we do have a couple more minutes before we wrap up here, we're just going to go through a couple different patterns, trade ideas, because I always like to do that before closing the session today. So let's take a look at NOVT, Novanta. We're seeing a massive range here in Novanta. We just saw a bounce from that range here. The upper part of the range is going to be 133, which is over a $20 move in that case, and it's definitely on the move today we've seen there. Now, Baker Hughes, that's another one I kind of stumbled across. We're seeing a triangle formation taking place with a, let's see how long this base is. That is a $7 base roughly. So could see a breakout to either side, but it looks like the trend has been up. Prices obviously coiling in that triangle there. Now, Murphy Oil is another one. Looking at a descending triangle here, we're actually right at the level of resistance in that triangle. So that could be something to watch too in the energy space. This one was kind of fun just because this is a pattern that you don't see quite often, which I'm going to show you on the longer term. Could be a start of a flag in the shorter term, but if we back it out to the longer term chart, this is called a diamond top formation. So this usually takes place over a really large amount of time, which is typically a broadening formation. So kind of that megaphone pattern mixed with a triangle formation here. And you can see on the max weekly chart, this is just such a big possible bearish reversal signal there. And what you're going to do is just measure the highs and the lows with that pattern, and you could project that to the downside. So just kind of a fun pattern that we see there. We don't see that too often there, so that's an IP. And then let's look at Abercrombie and Fitch. We have seen quite a bit of a range here. Price is coiling, leading into earnings at the end of the month here, forming a triangle pattern there. SLB actually, it looked like it broke out of like this bull pennant pattern today. It looks like that pattern, or yesterday, but then it looked like that pattern failed and moved back into it, obviously within that longer term range. So we could just say that was a resistance bounce there from that range there. And then Costco still leading into earnings. Next month, we're seeing a coil take place there as well. So we went through 2 different trades, reviewed our trades, reviewed the markets, showed you some new possible trade ideas, new formations that traders may be keeping their eye on. I just want to thank all of you in the chat. Yes, diamond patterns are cool to see there. They're not too commonly discussed. So good point, Mike. I want to thank you, Mike, in the chat, everyone in the chat. Please fill out that survey. Like I said, we definitely take that all into consideration. And I just want to make sure you guys look to give us a follow on X, Mike Fairborn CS, Rachel-CS. Please thumbs up this video to help the algorithm of you and other traders. And please subscribe to our channel on Trader Talks. Thank you, and I'll see you next week.